The whole of the fiat currency system post Bretton Woods is now running out of time. The reason that China has accumulated gold and Russia is doing it so as well, quite simply, is because under Marxist theory, they reckon that capitalism is doomed and the currencies will be doomed with it. The only protection which they understand, and of course you and I understand, is to tie the value of their credit, yuan or rubles or whatever it might be, to gold. And if you tie it irrevocably to gold, then you protect yourself from the mess that we in the West have got ourselves into.
In today's news recap, silver price forecast. Can the market recover after its worst week since 2020? Silver posted its worst weekly performance since 2020, falling over 13% as traders grappled with deepening recession fears, forced liquidations, and a deteriorating industrial demand outlook. The sell-off reflects mounting macro stress, with trade policy under President Trump playing a central role in reshaping the demand landscape for the metal. President Trump's announcement of sweeping reciprocal tariffs and targeted measures against China triggered a reassessment of global trade flows and manufacturing prospects. Semiconductor tariffs are particularly bearish for silver, given its widespread industrial applications. China's response, slapping a 34% levy on all American goods, adds to fears of a drawn-out trade war. The result has been a sharp drop in global demand expectations, particularly in Asia and Europe, two major industrial buyers of silver. A violent decline in equities, highlighted by a 2,000-plus point drop in Dow futures, unleashed margin call selling across the board. Silver was hit especially hard as investors were forced to exit positions to cover losses elsewhere. While gold also saw liquidation, its safe haven bid helped cushion losses. For silver, with weaker monetary demand and no central bank support, the impact was deeper and more sustained. Silver's weakness was compounded by a rising U.S. dollar and an uptick in real yields. Treasury markets stabilized after strong jobs data, pushing the 10-year yield back near 3.88%. The dollar gained as expectations for aggressive Fed cuts were scaled back. Traders now turn their attention to this week's Fed minutes and Thursday's CPI report, both of which could reshape policy expectations. If the minutes signal hesitation to ease, or if CPI comes in hot, silver could face further headwinds from tighter financial conditions and a stronger dollar. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
I think the American banking system is giving a problem to what we in England call the SMEs, the small and medium-sized enterprises. They're not lending. They're not providing the liquidity that businesses need. And the reason for that is they see risk. We've seen with the commercial real estate business, for example, in various other areas. This is something that bankers just don't want to know now because they see risk. Business out in outside the main conurbations is not good. So what they're doing basically is they're lending money to the government, and they're lending money to by buying T-bills. I mean, they can't destroy credit once they've created. This is the problem. The only way credit gets destroyed is when people go bust and they default. So they're stuck with credit. So what they're trying to do is they're trying to move the credit from risk to what the regulators say is non-risk. In other words, you're looking at short-term finance for government. And that's basically what the banks are doing. Now, interest rates will rise, and I can explain why. I think that's a separate question. The consequences for that will be huge, great problems developing for the entire financial system. I mean, I can see the equity market bubble bursting completely. I think President Trump's tariffs, I call those Smoot-Hawley Mark II, basically. And if you think about it, 1929, we had a credit bubble which bust. That was the Roaring Twenties. And we had Smoot-Hawley at the same time, which was legislated, or it was signed into law by Hoover in 1930. It was that combination, basically, that killed the global economy. And here we are going down the same route. This is important because the banks basically are the guys, if you like, who are taking the risk on this. And but at the end of the day, of course, we don't want our banks to go bust, and the central banks will do what they can to rescue them. But Andy, there's another problem, and that is that the central banks are all deeply in negative equity. People think that it doesn't matter because they can always print their way out of trouble. But yeah, if they do that, they collapse the currencies. And there is another problem, and that is that, if they don't print their way out of problems, then they have to turn around to their major shareholder, which in this case is governments, for finance. But the governments themselves are in a debt trap. So the governments, the whole situation actually is all it's all set to fall over. That's the trouble we face. And that's why it's so important to understand the difference between money and credit. Money being gold, credit being everything else.
In today's news recap, gold drops sharply amid market panic, but fundamentals remain strong. Global markets opened the week under pressure, with major equity indices tumbling once again as volatility swept through the Asian session. The latest wave of selling follows China's announcement of retaliatory tariffs on the U.S., intensifying the fallout from last week's Liberation Day tariff shock. Investors had hoped that the worst of the uncertainty would fade following the initial U.S. tariff announcements. Instead, the reality has proven more severe. With tariffs exceeding expectations and no sign of negotiations, markets are now increasingly pricing in the risk of a global recession, beginning with the U.S. This risk-off mood has triggered broad-based liquidation across asset classes. Even traditional safe havens have not been spared. Gold, typically a beneficiary of risk aversion, has not been immune. XAU/USD has dropped more than 6% since Thursday, a move that seems to defy its status as a hedge during times of market stress. The likely explanation: forced liquidation. As losses pile up elsewhere, investors appear to be selling profitable or liquid assets like gold to meet margin calls or reduce exposure. As a result, this sell-off looks more technical and sentiment-driven than fundamental. The key factors that have supported gold remain intact, though. Looking beyond the short-term panic, the medium to long-term outlook for gold remains bullish. The current environment, marked by volatility, economic uncertainty, and central bank caution, typically favors gold. Last week, Fed Chair Jerome Powell reaffirmed the Fed's wait-and-see approach in response to the unfolding instability. This week's March CPI release will be crucial. If inflation data shows further softening, it could strengthen the case for future rate cuts, potentially reigniting demand for gold. On the other hand, a surprise uptick in inflation could limit the Fed's ability to ease, injecting more uncertainty into the macro picture. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Sort of, if you like, being offered the option to subscribe for US Treasury debt. he will start thinking, okay, if I'm going to buy this debt, what's going to be the purchasing power of the currency which I have to buy in order to buy this debt? Now, if the purchasing power of the currency is going to decline by, say, in my estimation, say 5 or 6%, then quite frankly, to get a 4.3% yield on the 10-year proposition, forget it. No, it's got to rise. And the other problem that we have, I mentioned a debt trap. I mean, when you get a situation where GDP is growing at a slower rate than government debt, basically the basis in which government debt is financed, or government finances are financed, is basically the revenue base, which is proportional to GDP. And if that's not growing as fast as the debt, then the debt is basically running away with the situation. It's called a debt trap. And that's really where the US government is. And it's not just the US government, it's most of the major G7s, with the exception so far of Germany. So, that's why interest rates rise. I mean, let's look at it another way. Imagine that this is 1923 and you're in Germany. The economy is in such a mess. It's horrid. It really is horrid. So how does the government rescue things? Suppresses interest rates to zero? What? The interest rate is a reflection of the development, if you like, the evolution of the purchasing power of the currency. And if the currency is going down, and this is what gold is telling us, actually, we don't need me to tell anyone, gold is telling us the currencies are going down, then interest rates have got to go up. It's actually quite simple. And we've got a real problem because it's not just, you can't sort of just wave a magic wand and say, oh, well, just put the dollar back on the gold standard. The problem is that the US Treasury is invested in getting gold out of the monetary system entirely and has been describing as a pet rock or whatever. And not only that, but the entire intellectual economic establishment believes in sort of, if you like, macroeconomics, Keynesian and monetary, but particularly Keynesian. And they've got to be persuaded off that. I mean, the whole of the macroeconomic thing is basically a non-science. And so you've got to re-educate the entire establishment.
And that's Alasdair Macleod's take on the evolving role of gold and the BRICS nations' ambitious plans to challenge the global financial order. What do you think? Do the BRICS nations' master plan for a gold-linked system hold the potential to reshape the global economy, or are the obstacles too great? Let us know your thoughts in the comments below, and don't forget to like and subscribe for more daily recaps. Now watch this video right here because it's a perfect fit for you. I'll see you on the other side.